COVID really helped a lot, Ted, to get families to rethink and bring their parents or grandparents away from big box. Of course, they are doing great job. There are lots of great ones, but they want more personal feelings into residential. So I'm just so fired up about this. Dear friends, this is Vinney Chopra. Thank you for liking the podcast and all the shows. Vinney and Walter, we do that Abundance Mindset show, which goes live in all social channels on Thursday at 9 a.m. Pacific, and also Vinney and Bo show, which goes also on Friday at 9 a.m. Pacific. And thank you for really liking the books and all the content that my team puts out for you. Please enjoy this episode. Thank you again. Thank you so much. Hi friends, this is Vinney Chopra from here in Danville, California. And you might be saying, hey Vinney, what are these over here? You know, I wrote this book a few years back, Apartment Syndication Made Easy. It became top seller. I came from India with $7 in my pocket. It says 500 million. It's going to be 1 billion very soon, very soon. I'm right at about 850, 900 million. And then I'm ready for the next billion. Actually, you will see that happening, 2 billion in this book also. The other book I wrote, which has been a very big positivity, has been my life. Always, I've been married 43 years with 2 children, and the beauty is to be positive, the mindset that can take you to all the places in the world. And that's the book that also became big seller. My third book, Senior Assisted Living, is coming. So do yourself a favor, go ahead and click the link below to get free copies, audio copies of these books, even printed copies of these books. Printed means digital if you can't afford it, but I would highly recommend for you to get these, or go to Amazon.com. Just go to Amazon. I got it in soft cover, in hardcover, in Kindle, in audio, also the Spanish version of this book also. So let's crush it, guys. I know you can be successful. I know you can do the kind of things that you want to do in life and have the streams of income and know how to really, educate yourself so that you could become a strong force in this world in real estate. I know you can. So take that step. Don't just be on the sideline. Take charge of your life. Take charge of your education. Hi there, guys. Vinney Chopra back again with Apartment Syndication Made Easy, Abundance Mindset show that I do live every Thursday. I hope you're liking that. 9 a.m. Pacific with Brother Walter from Tampa in the Alchemist Nation, and also on Friday with Brother Bo. I do again another show, 9 a.m. Pacific, which is Vinney and Bo show. We've been doing it for 3-4 years now. Really excited. And then Apartment Syndication Made Easy, which is this one with lots of different inner circle, mastermind, my great guests that I bring in. And today we got a fantastic show for you. Ted Lanzaro is here, my good friend from Connecticut. He's a top-notch CPA, highly recognized certified public accountant and real estate investor. That's what I love also, because he knows the ins and outs of real estate and taxation. And he is the founder of Landmark CPA Group, located in Shelton, Connecticut, a boutique CPA firm specializing in accounting and taxation for the real estate investors. Over 33 years of experience. We're going to learn so much from him. We're going to talk today about how the income is generated in rental versus services market, in the tax treatment of each of it, depreciation benefits for owners and investors. You've got to really love that. And also the importance of tax planning, especially when buying, renovating, and selling. Ted, welcome. Thanks for taking the time.
Vinney, thank you for having me on.
Oh, it's such a pleasure. I know you were just traveling over there in Europe and we had just come back. Thank you for picking up the phone. And, you had just had the dinner with your lovely wife. And how was the trip? Was it lovely? Yeah.
Oh my God, it was wonderful. I really love that part of Southern France. My wife and I love it. We try to get there once a year at least. It's just a great place.
It's beautiful. Nice, Cannes, Monaco, the whole area there is so friendly. I remember my wife and our kids went, it was so nice. And I remember the rounded pebble beaches. These are stones in the Nice beach, especially Nice. I remember people are so much over there on the beach, but it's not sand, but it's the small rounded pebbles which kind of give you massage in the feet.
Yeah, no, it's true. There's the rock beaches in Nice, and then if you go more towards Cannes, then you get the sandier beaches, which they're both beautiful. And in
Yes,
the
they
summertime, they're all pretty.
fact.
Yeah.
Yes, and eating is such a big delight there. Oh my gosh, the cuisines and everybody says outdoor eating over there. I still remember it. Flocks of people outside the restaurants, very nicely appointed. Just a beautiful place. No, but it's good to come back to USA and then go back to travel and so on. So let's talk about as I pivoted a little bit like a circle. Here I was in a single family home duplex to 14 units to 100 units to 7,500 units at the peak, then selling them and then building senior livings and even going from multifamily senior living back to residential assisted living. Vinny is going through a circle, and that's where I'm find the wealth building and the cash flow is so huge in residential assisted living homes. What? And they're low hanging fruit, I call it, because you don't have to syndicate. You could even take your own retirement funds and your own monies and all that and do it. So thank you for, so let's discuss how that market, how can we benefit from taxations?
Yeah, I mean, what's good about the residential assisted living, especially if you're going to own it yourself, or if you're
Yes,
going to
yes.
do a joint, maybe you're doing a joint venture with some friends or whatever. It doesn't
Mhm.
have to be a huge syndication. You could have,
No,
you could have a partner, you could do it yourself. You're
yeah,
getting all of that appreciation essentially for yourself. You're not having to give part of it away to investors, and it
yes,
can really help you mitigate any other tax liabilities that you have. Say, just for example, in your case, from maybe selling out of some of the larger properties you were in and getting into these smaller residential assisted living houses where you're getting all of the depreciation on your tax return.
for sure. And also because there's so much furniture, so much equipment and other stuff, and commercial also, and more utensils. So, how does that go about bonus depreciation and cost segregation? Could you throw light on that?
Yeah, that it's almost like when it's similar in structure to having a short-term rental, perhaps, right? Where you're buying all of the furniture and the like you said, all like the kitchen utensils and
Yeah.
supplies and plates and
Hmm.
pots and whatever else you put in there. It's like
Yeah.
everything that goes in there, most of that stuff is going to be 5-year assets. And
Yep.
the furniture will be 7 years, but it's still
Yep.
subject to bonus depreciation. So
Hmm.
think about if you were to buy a house that you could do this with for say $500,000. Not only would
Hmm.
you be able to cost segregate the component pieces of that property. There's got to be some tangible personal property and some land improvements in a house like that, but also then adding the furniture and fixtures and supplies and appliances and whatever, all the other things that you need in the
Yep.
house to make it
Hmm.
run. So all of those things would be added bonus depreciation, right? So you can really get a
Yes.
really nice first year hit,
Hmm.
and you get the ongoing remainder of the depreciation for
Yes.
the next 5 to 7 years.
For
Because, like
sure.
in 2024, you're only able to take the 60% bonus depreciation. So you still have the 40% of the cost basis to then allocate over 5 or 7 years. So you end up with a very nice stream of depreciation deductions.
Totally. I was thinking like in the assisted livings, sprinkler system is a necessity, fire alarm system, and lots of fixed assets which we don't really use in single family rentals. but we need it for assisted living. Also, the front and the backyard, and also for the seniors to enjoy the backyard, grills and fireplace, you name it, all different things. Would they be deductible also? And the whole
Yeah,
capex budget, we could spend 150,000 easy to renovate a property when we buy one, so that all that will be deductible, right?
yeah. Not only so, all of that is deductible
Mm.
as you can capitalize it. Some of it you could just expense, right? Some of it would be de
Yep.
minimis and you could expense it. The bigger stuff, the security systems, the outside sprinklers for the lawn would be a land
Yeah.
improvement. The stuff, the security and fire alarms and that kind of stuff, those would all be 5 year assets. And the rest of the stuff would probably just be regular, just 5 year assets. Also,
Mhm.
like the grill stuff you were talking about outside, you
Yeah.
had
Yeah.
chairs and tables and patios and stuff. And again, it's almost like a vacation rental. You're
So
putting
true.
a lot of stuff in there to be able to keep it running. And so
Yes.
what's nice about that is that you have this ability to create tax deductions based on what you put into it. And you can almost plan it out, right? Like you can pick
Mm.
your level of
Yeah.
what you want to put in there so you know what to deduct. The other thing too, so let's say you buy so you have to keep this in mind. When you buy a property, let's say you buy a house, right?
Hmm.
Now the house needs work. Like you said, you have a CapEx budget. You're
Yep.
gonna go in and you're gonna renovate the property,
Yep.
right? You need to talk to your cost segregation study company because
Yep.
they can do a disposal study as part of your cost seg study, right? So you go in, just as
Yes.
an example, on a smaller level, because these are smaller properties, right?
Mm.
You can take pictures of everything that was in the house when you bought it.
Yep.
Literally, the day you
Mm.
close, you go walk through it with a video camera, right?
Mm.
Now, all of the things that you remove from that
Ah,
house as part of the renovations, your
yes.
segregation study company can value those and create a write off. You reduce the basis of purchase
Yes.
price of the house, but you're able to get an ordinary write off for all of those things that you disposed of during the renovation, right? So it can create
Hmm.
a nice upfront tax deduction. Now you go and you renovate, you put all new stuff in there, and then you cost segregate that. And you end up with a double bang. You get the cost segregation
Hmm.
depreciation, and you get the
Yes.
disposition loss for all the things that were pulled out of the house.
Beautiful, beautiful. This is so intricate. It's so exciting. I think not too many people are even aware of this. I heard about it few years back when I was doing same thing over there in Atlanta, Georgia, and in Florida. I'm so thankful you reminded that we should be really getting some good cost segregation companies involved to have the double whammy. I hope everybody watching us or listening to us go back and listen to what Ted is saying. This is a very good point. Very good point.
Yeah, because it all depends. If you're buying houses, renovating them first, and that's a great strategy.
Yeah.
If you don't do that, you're missing out on a pretty substantial deduction because you probably get
Yes.
rid of a lot of stuff. If you're buying turnkey properties, like you're buying something and
Mhm.
you're just going to be able to start moving people in day one once you get it furnished and everything, that
Yeah.
maybe that's not a strategy you can use then,
True.
but you're going to get better prices and everybody's looking for value add, right? That's how you add value as you take
Totally.
a property that's in disrepair and you're essentially converting it probably from some sort of residential use or something into a more commercial use as a residential assisted living. By doing those renovations, maybe you're having to do small additions to create more room. Maybe you're having
Yes.
to move some walls to make things more compatible with your
Hmm.
purpose. So all of that kind of
Yes.
repositioning of the house or adding on to it, all of that backs.
I
There's
love
a
it.
bonus depreciation component of all of that stuff.
That's awesome. This is a new leg to really value add of taking a house in a good community, but which can be converted. If it's 5 bedroom, like in Arizona, I'm buying 10 bedrooms. So we could even add in the backyard if the zoning permits and everything, and if it's the right location. add rooms, just like you said, knock off walls and change the roofs and put money into it so that now the house is worth a lot more. But then you build the component of serving the seniors, assisted senior living with one house, which might give us a rent of 5,000. If there are 10 rooms, then each room gives 5,000. So then 10 rooms give you 50,000 revenue. And after 70% given away as expenses and things like that, you can walk away with 10,000 plus net cash flow per month, 2 years. And it's getting me so fired up about it. And we are 1.3 million beds short today. 1.3 million beds short in assisted senior living. This is mind boggling. And the other part is residential assisted living gives better care because the caregiver ratio to the seniors is like 4-1 or 5-1 as compared to big box, which is like maybe 15-1 or 20-1. COVID really helped a lot, Ted, to get families to rethink and bring their parents or grandparents away from big box. Of course, they are doing great job. There are lots of great ones, but they want more personal feelings into residential. So I'm just so fired up about this. So let's talk about, again, we talked so much about depreciation benefits for owners and investors. So could you take us through there? Let's see if some buddy bought the home and somebody else is operating the business. What are the tax ramifications of those?
Yeah, and that's an interesting point because with these residential assisted living, you do have that dual component of the rental plus the services, right? And if you
Yes,
have,
yes,
and there are a lot of people, I understand that you have two different companies, you're doing both,
yes,
right? But there are some
yes,
people owned by the houses, right? Fill
yes,
them and then hire a professional manager, healthcare management company to go in and perform those services and then pay
yes.
that company for those services. So now if I'm on the rental side, I'm the owner of the property. Okay,
Mhm.
I'm getting the depreciation benefits of we just talked about all
Yes,
of the
yes,
depreciation on the house, all the depreciation on the furniture, all of this other stuff.
yep,
Now, on the management company side, the management company would have its own. Now, that's going to be different from the rental income because it's going to be services income. So you actually have
yeah,
operating income. You're running a trader business. Okay. So instead of using bonus depreciation, if you have the income, you use what's called Section 179 depreciation on those fixed assets, right?
mhm,
And what's great about Section 179 is there's no 60%. Like this year, it's 60% bonus depreciation. You can still take 100% Section
ah,
179. So let's say,
yes,
just as an example, as the operator, you're the manager providing services. Let's say, just as an example, one of those services is transportation, right?
yep,
You
mhm,
bought a van and you have a
mhm,
driver that takes people to doctor's appointments, right?
yep,
Now that
mhm,
van can be 100% Section 179 depreciation in the year you
yep,
buy the van.
yep,
Now, some of these vans can get pretty expensive if you have to
mhm,
outfit them
yep,
for elderly people to be able to get in and out of
elderly
them.
people,
That gets pricey, right? So
yes,
then there's other assets that the operating company is using to facilitate operations, right?
yep,
And those would
yep,
be subject to 179 depreciation also, right? So what you could create in your scenario, you have the rental and the operations separate.
yes,
You actually
yes,
could be taking bonus depreciation on the property and the furniture and
yes,
Section 179 depreciation on the fixed assets that you're using in the operations, the providing of
operations.
services business.
Wow. No, this is fantastic. I mean, 179, I remember reading about it when I bought the hotel over
Mhm.
there in Texas, and then we sold it, fortunately, for a lot of money, and then 1031 into another hotel, Wyndham Garden, which we love, 165 units. It's gone in value by 7 million, I heard. We just paid 13.9 million for it, 165 keys we lucked out. But let me ask you a question. 179 bonus depreciation, it's good for hotels, for operation side of any real estate or any business, or how?
So
Yeah.
typically you use bonus depreciation for real estate, and you can use bonus depreciation for ordinary trade or businesses also. But
Uh-huh.
nowadays, you're getting more benefit from Section 179 when you're operating a trade or business, right? But here's
Ah,
the caveat, okay? In order to take Section 179 depreciation in your trade or business, you have to have the income to offset the
yes,
deduction,
yes.
right? So if you have a
Mhm.
$100,000 depreciation deduction, you have to have $100,000 of income, and you can take it down to zero, but you can't create a
Wow.
loss. So let's say you're already running a business at a loss. Hopefully that's not the case, but let's say you are running a business at a loss and you have new fixed assets. That's when you can take the bonus depreciation to increase the loss, because you're not able to take the Section 179 because you have to have income in order to take Section 179. Now, there are cases where you can do both, right? In an
Oh.
ordinary trade or business, you
Mhm.
could, let's say you had $100,000 worth of depreciation, but you only have $50,000 worth of income. We could wipe out the first 50 with Section 179 and then take 30 more with 60% bonus depreciation.
Ah,
So,
got
so
it.
you can, in an
Mhm.
ordinary trade or business, you have that flexibility. Whereas on the real estate side, there is no Section 179.
Cost segregation, if somebody forgot to do it last year, can they amend it? And what are the laws about that?
You can do on a cost segregation study, you can do what's called a catch-up study.
Catch
So
up.
somebody who, let's say they bought the property in 2022, just as an example,
Mhm.
and in
Mhm.
2022 they weren't making a lot of money. So they really didn't have a reason to do a cost segregation study, because
Yes,
you
yes.
don't typically want to wipe out low bracket income, right? So if you're
Yeah.
only making $100,000 a year, and let's say that's all 15% tax bracket, right? You don't really want to wipe out 15% tax bracket income if you know that 5 years later your income is going to be $1 million and you're going to have to
Mm.
recapture it at 25%. So you
Yes.
always got to be cognizant. So we talk about, in my office, we have a concept we call year-round tax planning, right? And when we
Mhm.
do year-round tax planning for clients, we look at about a 5 year window with the client.
Wow.
Now, we're estimating based on the client's best knowledge, right, what their income is going to be. So we're talking to you, Vinny, right? We're talking to you about
Yep.
year-round tax planning. And you say
Yep.
to me, Ted, next year we're thinking about selling one of our hotels. And then the year
Mhm.
after that, we're going to sell one of our assisted livings and one of our apartment buildings. We think the gain is going to be $1 million on this and $500,000 on that or whatever. And my coaching income is this and blah, blah, blah. We lay out
Yeah.
what your
Yep.
income is going to look like over about a 5 year period. And
Mm.
then we start structuring things so that you get the most bang for your buck. So in this scenario, what you might want to do, let's say they bought the property in 2022, didn't need to do the cost segregation study.
Mm.
In
Yep.
2024, they have a lot of income. They still have the ability to do a cost segregation study. So you would do the cost segregation study, and then you would be able to catch up all of the depreciation that you haven't taken for those
Aha.
3 years based on the bonus depreciation,
Three.
right?
Okay.
Now you would
Correct.
get all of the depreciation, all of the bonus depreciation that you're entitled to, less what you took in those first 2 years. And I believe it's called a Section 481 adjustment. And you have to
Oh, I
file a
see.
Form 3115 with the IRS when you do that.
Yes.
But it's part of the cost segregation study. The cost
Yeah.
segregation study firms typically do the 3115s. It's part of their regular business. They're experts at being able to figure out how much catch-up depreciation you'll have. So it's the same process. When you go to get a cost segregation study on a property, you go to the cost seg company and you say, look, I just bought this property. Here's the closing statement. Here's how much CapEx we're going to do, blah, blah, blah. And they'll typically give you an estimate of what they think the benefit that they'll be able to pull out of the property will be. So they'll give you, here's what we think we're going to be able to reclass. And then they'll give you, of course, they'll give you a fee quote also, right? So when you do a catch-up study, they do the exact same thing. They tell you how much catch-up depreciation you're going to have, and then you can make a decision as to how much that depreciation will help you. And certainly if you're in a high bracket, you always want to try to use cost segregation depreciation in high bracket years to wipe out income, because you get more benefit taking your income from $1 million down to 800,000 than you do taking your income from 200 to zero, right? Same $200,000 deduction, there might be a 10% difference in the rate.
Thank you for giving such great nuggets right there. Is it true that we could go back 5 years to recapture or catch up? Is there a limitation on that?
You can go back 5 years. Yeah, you can go back 5 years.
Up to 5 or
up
no
to
longer
5.
than up
Think
to
about
5?
this. If you, so the whole purpose of the longer you wait, the less benefit you get out of it, because on the 5-year assets, if you wait to year 5, you've already taken ordinary depreciation. There's not a lot of meat left on that bone.
Left on that,
right?
Now
you still would get the 15-year, right? So you'd pick up a whole bunch of 15-year.
And
but
27.5 or whatever for residential and 39 for commercial.
But the
So whatever
27.5, you're taking that anyway. So there's no catch up on that. You may end up, what might end up happening is, because you took it at 27.5 for that whole time, the longer you wait, the less actual thing, but you're still reclassing it to 15 years, right? It's even better on a 39. You know, if you're going to wait 5 years, it's better on a 39-year because you've taken less depreciation in the first 5 years. So you are, but typically the longer you wait, the less meat on the bone there is for you to take. But again, if I needed it in year 5, because year 5 was the year I had a lot of income, you can definitely do that for sure.
Excellent. In taxation world, how does it work? Like taking the money or profits from one LLC of your business, and with the monies, can we reinvest in the business? I know some people have asked me that, and does that give better taxation when we reuse the money or profits from the business to build more businesses?
It does from this standpoint, right? What am I paying? So let's say, just as an example, you run a residential assisted living house, and after 2 years, you've made enough money to buy another residential assisted living house, right? So now you take the money out of your real estate LLC that you've been the original first one, and you go and buy another house, right? So it all depends on what you do with the money. If you took the money out of your LLC and you went and you invested it in another residential assisted living, you would definitely get a benefit. If you went and you invested it, you just started a business and you were just using it, say, for operating capital, right? You probably would get the deduction for whatever expenses you paid using that operational capital, but it would typically be less than the depreciation that you would get by buying another property. So it all depends on it all depends on what you do with it. And this is a mistake I see a lot of business owners making, right? Let's say I run a flower shop, right? I'm not in the real estate business, but I run the world's most successful flower shop, right? And it literally generates $1 million of extra cash every year, right? So 1 year I go and I buy a rental property. I go out and I buy an apartment building, right? Okay. But I'm not a real estate professional, and I make $1 million a year. I don't have the ability to deduct rental losses against my ordinary income.
Yes.
So
Yes.
now what I've done, and I see people do this all the time, they sucked all the money out of their business. They bought an investment, which overall is probably not the worst idea in the world, but you should have saved enough to pay your taxes, right? So if you were going to buy
Yeah.
$1 million apartment building, you should have bought maybe a $700,000 apartment building and kept 300 for your taxes, right? Because you
Mm-hmm.
you weren't going to, if you had talked to somebody like myself, you would have known you weren't going to get the deduction. So I see people
Surely.
pull money out of their LLCs all the time, buy things with them that they won't get a tax deduction on. So you can do it either way. The real question is, do you have the ability to deduct the losses? And that's something
Mm-hmm.
that's part of year-round tax planning. You need to be talking to your CPA and
Mm-hmm.
asking those questions before you do it so that you know what the ramifications are and you're not surprised by the ramifications in April when you get your tax bill.
So true,
Right?
so true. No, I'm so happy that you came on the show and giving so many great nuggets to everybody watching. Hey guys, if you like this episode, please comment, give comment, share this episode so that other people that you know in your circles might benefit from all the great knowledge that Ted is giving us right there. Let me ask you a question. Again, any points you would like to wrap up with? Thank you so much for giving the time. It's your precious time today. Yeah.
It is always my pleasure. And,
Ah.
it's actually a nice break in the day and I have fun doing it. And you being you're probably my favorite person to do this with because I have never left
Ah.
a podcast or anything I've done with you not in a good mood. You have such
Ah.
infectious and happy energy that you're like a nice break and make me put me in a better mood, right? So I think to end this, I'll say a couple of things. One,
Sure.
I think the biggest mistake that not only real estate investors, but business owners in general make is to not communicate during the year with your CPA. And I asked too many questions. I want to know too much about what's going on. But that's how you get the best tax strategy and the best planning
Yes.
and the best
Yeah.
advice is to
Yes.
communicate because there's a lot of things that we can do now during the year before the end of the year that we can't do after December 31st,
So
for
true.
example. We can't, you
Yes.
can't write checks, that are deductible in 2024, in 2025, but you can in
Yes.
2024, right?
Mm.
So there's a lot of things that we do for clients, a lot of advice we give that helps them save money during the year. And that's the result of their communicating. And like with my real estate clients, I always tell them, I need to know before you buy, before you
Yes.
renovate, or before you sell
Sell.
a property. And the reason I
Mm-hmm.
do that is because there's those strategies that we just talked about, right? All of
Mm-hmm.
those things have to be
Mm-hmm.
set up in advance, right
Yep.
after you close,
Yep.
right? So
So
it's
true.
that kind of stuff, right? And if you're interested in learning more about what I
Please.
do, right?
Yes. How can people reach you, Ted?
Yeah, they can
Yeah.
reach
Please
me.
tell.
My website is www.landmarkcpagroup.com. My email is really simple. It's ted@landmarkcpagroup.com. And you can reach me either of those ways. There's a do business with Landmark CPA Group page on the website where you can type in information. It goes right to my email, and then I can get back to you and we can set up the time to talk about your situation because everyone's got a unique situation. And what we're all about is creating like tailored strategic tax reduction strategies that help people save money every year. That's what we're doing for our clients literally year round.
I love it. Thank you, Ted. Thank you so much. Again, guys, please share this episode. We'll see you in the next episode.
Be sure to listen to Mr. Smiles next week with more golden nuggets and top-notch coaching tips. You can reach him by going to VinneyChopra.com. Be sure to like, comment, and share to show everyone how Mr. Smiles has brought your apartment syndication business to the next level.